Today on TLC Live, a week after Silicon Valley Bank collapse, what happened? Who and how will impact and what to expect now? Join us today, Dr. Daniel Perez Liston, Assistant Professor of Finance at the University of Houston downtown. Michael Anderson, retired FBI white-collar crime expert who was the supervisor of the Enron Task Force in Houston. Also, Gustavo Suarez, founder of Trez, a tech company based on Silicon Valley. Good morning, everybody. Welcome to TLC Live. I'm Andrea Gomez.
And I'm Orlando Sanchez. Buenos días.
Buenos días, Orlando.
¿Cómo la pasaste?
Muy bien, muy bien. How was everything in Dallas?
Dallas is Dallas.
Dallas is Dallas.
It's a lovely town.
It's a lovely town?
Yeah.
Okay.
Yeah.
Well, a lot of things going on in the finance bank world since last week. Many things having changed. People trying to understand what has been going on. People are saying that we should not have regional banks. You read the news. People are saying, experts are saying, it's a mix of opinions, a mix of, everything is still in investigation, under investigation. So that's why we decided to do the show about that, because we want to understand what is going on, what is the impact and the consequences. And they were also, I was reading on the news that 190 regional banks around the country, everybody's talking like what is going to happen to those banks. They are in risk, they are not at risk. So there's a lot of saying in the media.
Yeah, I mean, I don't think there's a difference between regional banks and national banks.
And you are part of one of the banks.
You have Wells Fargo, who had, first of all, we had the fiasco under the Bush administration of the mortgage collapse. But that was a matter of public policy. They were pushing excessive loans without the financial backup of the mortgage applicants, and they were selling these instruments left and right, and Wall Street was buying them, and it created that collapse. Now, banks fail all the time, but what's interesting to me, Andrea, is that I've been on a bank board for 15 years and currently serve on the bank board. We're constantly reviewed by the FDIC, by state examiners. We have external auditors, and our board is very active. Mm-hmm. We know every month what's going on with the bank. We know, what our concentration of, let's say, commercial loans are. We know what our rate of, ROI is. We do the SARS, the suspicious activity reports based on certain industries. And it's always been fascinating to me how banks get to this point without the board of directors, the external auditors, FDIC, and if they're a state chartered bank, how do they get by the state examiners? So it'll be interesting to have this conversation with our financial experts, because I tell you, I sit at these board meetings and I read everything and I look at everything and I ask questions. So I don't know how this happens, but so maybe we can be enlightened.
Yeah, so let's explain first what happened, and I want to introduce one of our guests, which is Dr. Daniel Perez Liston from the University of Houston. Daniel, welcome to TLC. Thank you again for always make the time to be with us and talk about these important topics. So, Daniel, let's start with explain what happened last week.
Andrea, hi Orlando, how you doing? Thank you for having me back on your show. It was a very interesting week, to say the least. We had basically one very large bank. I think it's the second largest bankruptcy that we've seen in the history of our country, where Silicon Valley Bank basically went bankrupt or became insolvent. So it was a very dramatic week, a very large bank. I think it has roughly $200 billion in assets. It became insolvent. What basically happened is a very large bank with $200 billion in assets had basically a bank run. So I think it was roughly $43 billion in withdrawals, like within a single day. So I think it was on Thursday where roughly they withdrew $43 billion, which is like an extreme amount of money, and the bank basically became insolvent by Friday. So it was just like an extreme amount of money that was just withdrawn from the bank, and basically no bank can take this amount of money being withdrawn. So that's basically what we saw. So it was a very rapid withdrawal of money. I agree with what Orlando was saying right now, where it's kind of like it's hard to fathom where a bank that has this amount of assets that's been regulated, where the regulators are overseeing the bank, they're taking a look at the risk that they're taking, like all these different things, and then all of a sudden it just becomes insolvent like within a few days. So it's just like a very difficult situation. But when you take a look at the amount of withdrawals that happen within a single day, it's just something that's just not tenable. Like it's just like banks just can't take a bank run like this. So that's why we saw like very aggressive action by the Federal Reserve and by the FDIC, where they tried to calm the markets, like over the weekend, and just like back all these banks and everything. So that's pretty much what we saw. This was very much like a classic bank run. Um, that's pretty much what we saw.
Well, yeah, but let me just say, I don't think anybody wakes up one day and says, "I'm going to go withdraw everything from my account at that bank."
Mhm.
Something led up to that. There was some genesis, some important report that led depositors to withdraw their funds from the bank. You have any idea what that was? And this is where my question
That's
is what certainly the FDIC, state regulators, board of directors. Didn't someone see something coming, or did someone on the board leak out that the bank was in deep financial trouble, and all of a sudden everybody in the community decided, "Uh-oh, time to move our money"?
That's a very good point, Orlando. And I wish I had more information on that, but I'm just like you. I have like no, particular information on what led to these like incredible withdrawals of like roughly $43 billion within a single day.
Yeah.
There's an investigation going on right now. They're going to look into this. We'll probably know what happened, within the months to come. But there's no particular information. I think there's like social media that was involved. So bank. I'm sure that social media was involved. A lot of communication was probably involved in the San Francisco area, and that kind of like probably spread the news very quickly, and that probably like generated some kind of like contagion effect,
Mm.
and people just got scared and they went and got their money. But what triggered this thing? It's hard to know. Now, in unfortunately in the environment that we live in now, communication and information spreads very quickly, and we've seen this in financial markets with these like flash crashes and so on, where we've seen the stock market just drop all of a sudden for no good reason. 1,000 points, 2,000 points in a day, like just quickly, like within a few hours or a few minutes. So we're experiencing like a new situation or a new environment where information just spreads very quickly. So I'm not surprised if this just happened all of a sudden for no good reason, just out of noise, just out of like these animal spirits. But there might be like a fundamental reason as to why it happened.
Well, it's very
And
interesting because I think that's why Elon Musk got in trouble. Remember when he said that he made a statement which created massive fluctuations in the equity markets on Twitter, I guess, and so I'm assuming that the corporate types, either board members or CEOs, have some serious financial responsibilities in terms of what public statements they make. It will be interesting, but um, I still find it incredible that a bank of, as you say, $200 billion in assets is quite a substantial bank. Uh, and it was interesting the first couple of days that Mark Cuban and several others were calling on the government to step in and protect the shareholders. No,
yeah,
you know, we don't do that, and it put a lot of pressure on the Biden administration. I think Biden had to respond pretty quickly, and I think the public needs to understand that there's a difference between shareholders and depositors. The
yeah,
depositors are generally covered by insurance, Federal Deposit
yeah,
Insurance Corporation, the FDIC. I don't remember
yeah.
what the limits are. I mean, it used to be 50,000. It's probably a quarter million right now.
Two
So
hundred fifty. Yeah,
depositors, I think, will be protected up to a certain amount. Of course, there are wealthy people that will deposit, 100 million, 200 million, and unfortunately, insurance companies have limits, so they won't cover all of it. But the average depositor will be protected. The shareholders are something else, so it'll be interesting to see how this
Yeah.
uh,
Now, the
works.
interesting thing about this bank, Orlando, was that in this particular case for SVB, 97% of the deposits were above 250,000. So most of the deposits in this particular bank would not be covered, right? So that's where the Fed and the FDIC decided that they're going to go ahead and cover those deposits anyway, even
Hmm.
if it's above the $250,000 limit, which I
Yeah.
think was something that calmed the markets and calmed people because can you imagine a situation where the majority of those depositors would just like be left out and just be left out in the open, left to dry. Um, so I think the Federal Reserve acted very quickly. The FDIC acted very quickly, did the right thing. They stopped, the bleeding. They kind of like, treated the patient in the ICU and stopped the bleeding and everything. But we're still in a very difficult situation. I think the months to come are going to be difficult months, and we might see some difficult moments in the economy for sure.
Well, and we had some problems across the pond over the weekend, did we not? Was it Credit Suisse or was it Deutsche Bank? I can't remember who it was, but
Credit Suisse,
there's
yeah, Credit
there's
Suisse
been
was
some
having some
rippling
major
effect.
issues. Yeah, and it's a ripple effect, and that's the thing about banks. Banks are not a typical you know business. It's not like McDonald's or like Tesla. It's not a typical business like bank. There's what we call contagion, and people are afraid of their money. I mean, when people start hearing that there's risk and they're going to lose their money, you might have these bank runs, right? And these contagion effects, and we saw it, like you said, in Europe over the weekend. So that was also resolved. But the Credit Suisse was a different situation that actually evolved over more than a decade. That bank had been suffering for more than a decade. The SVB situation was something that just happened, pretty much like overnight.
Yeah.
And the Federal Reserve did a pretty good job at just like
And
stopping
I and
that
I think people need
pretty
to know.
much.
You
But
talk about contagion. Big banks like that. Hundreds of billions of dollars in assets. Obviously, they're engaged in substantial business deals, and so there's syndication that goes on, right? In other words, banks do have limits on the amount of loans and the concentration of loans. In other words, they can't put all of their loan portfolio into, let's say, oil and gas. They have limitations on real estate investment. Typical mortgages, oil and gas, that kind of thing. But when they get big loans, they join a syndication, do they not? And that's where potential contagion comes in.
yeah, there's definitely contagion effects, like you said. They join syndicates and stuff like that. Now, in this particular case, SVB took some risks that other banks were taking, just because of the location that they're in and the types of businesses that they were doing. But it's just a strange situation. I mean, really, their portfolio where they were taking losses, and that's another thing I think, and that's where the Federal Reserve I think is a little bit scared right now because banks right now are holding a lot of these treasury bills and these safer assets, right? They're holding these safe assets, and these safe assets have actually generated these unrealized losses, right? And they're holding these assets, these very safe assets, but they have these unrealized losses because interest rates have gone up.
Correct.
So as interest rates have gone up, the value of these assets have actually depreciated, but they're just sitting there in the balance sheets of these banks. And as long as they just sit there, they're fine. But when the bank is forced to sell them, and when are they forced to sell them? They're forced to sell them when deposits are actually withdrawn, right? When people withdraw their money from the bank. So that's what
Professor,
happened to SVB.
before we discuss the consequence at all levels with you, I want to go with Michael Anderson. He's a retired FBI, and he was also the supervisor back then, and when Enron, I think it's been 20 years, Michael, and you can give us more the insight about bring us back on the time. But also, I was reading that one of the senators are asking for the FBI to investigate what happened at the Silicon Valley Bank. So. Please, well, welcome to TLC first. Thank you for making the time. And give us a little bit of your background and the situation right now with the Silicon Valley Bank.
Andrea and Orlando, thank you for the opportunity to be here today and talk about this very significant case that's ongoing right now and impacting a lot of people. My background is white collar crime. I retired from the FBI after more than 28 years, and I've primarily investigated and supervised white collar crime my entire career, especially corporate fraud. I was a supervisor of the Enron task force here. And I think anytime there's a fraud case, there's a tendency to want to look at things through the lens of how does this compare to Enron? And I think we can make that comparison here, although there are similarities, but there are a lot of differences too. I mean, obviously, they're in different industries. Silicon Valley banking, Enron was one of the world's largest energy communications and natural gas companies. And if you look at the difference in the revenues, I think Silicon Valley Bank had about $8.5 billion in revenues in 2022. In the year 2001, Enron had more than $100 billion in revenue. If you bring that forward until today, that would be the equivalent of about $174 billion. So tremendous differences in size. But it's been reported that the Department of Justice, the Department of Justice Fraud Section, and the United States Attorney's Office in San Francisco have both opened or working jointly on an investigation into the failure or the insolvency of Silicon Valley Bank. Parallel with that, contemporaneous with that, is the Securities and Exchange Commission. They've opened an investigation. Also, the Massachusetts Attorney General's office and another agency in Massachusetts, they're looking at Silicon Valley Bank too. And kind of what all these agencies are looking at is, what did the executives know before this bank failed? What public statements did they make before this bank failed? And then secondly, is they're going to look at their stock sales. It's been reported that both the CEO and the chief financial officer both sold significant amounts of stock within a week of the bank failing. And that always leads to a lot of questions. Anytime in any corporation, when an executive sells stock, within a relatively short period of time of a very adverse event, you're going to look at that. Now, it's also been reported that these executives sold this stock consistent with a stock sale plan. I think it's a 10B 5-1 plan where, executives who have material non-public information can schedule their stock sales. And then, if something happens, they won't be accused of insider trading. But what you have to look at is you have to look at, when was this plan put in place? Were there any changes made to this plan? And I know at Enron, we convicted 4 of their executives on insider trading. Now, each of those executives, they had stock sales plans, but they amended those plans and very abruptly changed them and decided to sell stock.
And the question is, were the proper disclosures made to the SEC? Because,
Yes.
as you say, even if you do schedule the sale of equities, you have to fill out certain forms so the SEC knows and the public knows. But yeah, this will be real interesting because, as I said at the beginning of the show, Michael, is that these things don't happen overnight. Executives, board of directors, external auditors, even to some extent, if the FDIC was going in there and the Federal Reserve was going in there and examining the portfolios, and they looked good, that means that somebody was fibbing on the numbers, which we know that's what happened in Enron, right? They created this sort of charade of how great things were going when, in fact, we knew it was just sort of a pyramid scheme, right?
Absolutely. It took 40 years to build this bank, and it collapsed in 36 hours.
Yeah.
I mean, that just doesn't happen. That
Correct.
doesn't happen. So they're going to be looking at, one thing specifically the Securities and Exchange Commission will be looking at is, did Silicon Valley Bank and its executives, did they accurately report the risks that were out there? Did they accurately report what was going on inside the bank? What were the risk that they had? And let me follow up on one other thing in comparison between Silicon Valley Bank and Enron. You have to look at the roles of the board. Now, Enron had a very experienced board. They had the captains of industry, the captains of academia on their board, but that board was asleep at the wheel.
Hmm.
The board was, where Silicon Valley Bank, they had a very inexperienced board. If you look at their entire board, only one board member had banking experience. There was one man on that board that had more than 35 years of investment banking experience. But the rest of the board, you had an actor, an improv actor, you had a winemaker, you had a donor, a large Democratic donor to Nancy Pelosi. There was also, there was somebody who was previously in the Obama administration. And so this board lacked the experience to adequately represent the shareholders. And I think that's something that I think civil attorneys will look at too. You talk about criminal exposure, but you also have to look at civil exposure. I think Silicon Valley Bank executives and the board have significant civil liability in this. It was reported yesterday that in 2019, the Federal Reserve reached out to Silicon Valley Bank and expressed concern about their risk management practices. In 2020, they also said that, as a large bank, that their risk management practices were inadequate. Now, normally a bank would take action to correct those. And if they don't, then there could be an enforcement action against that particular bank. Well, it makes you question now, did Silicon Valley Bank take any action? I know it's been reported also for the last 6 months of 2022, there was no chief risk officer at Silicon Valley Bank. And this is during a period of time where the Fed was raising interest rates significantly. And so a bank with a chief risk officer or someone doing that function would look to hedge that risk. So you didn't have the adverse impact of having to sell these securities in a time where their value is decreasing because of a rise in interest rates.
Yeah, and it's striking to me because in many cases the regulators will come in and cite the bank and basically force them to sign what's called an MOU, a memorandum of understanding, with the regulators as to what are the remedies the board and management is going to take to correct the problem. So it'll be real interesting to see if they got to that point.
Yes. It's interesting, too, that the CEO of the bank served on the board of the Federal Reserve in San Francisco. I mean, to me, that's kind of a conflict of interest. That's a huge conflict of interest on both his part and the Federal Reserve Bank in San Francisco.
Yeah.
Well, Michael, don't stay with us, but I want to bring Gustavo Suarez. He is the founder of Trez. It's a tech company that is based in Silicon Valley. Gustavo, what did that means? What happened in Silicon Valley Bank to the tech companies? Because we know that Silicon Valley Bank was having a lot of money and funding a lot of money to tech companies in Silicon Valley.
Well, but first of all, I want Gustavo to explain to our listeners how tech companies, what is the path by which they take. For example, if Gustavo started Trez, he doesn't go to a bank with a concept and an idea. He has no assets, let's say, he's in the incubation period. He goes to angel funders and private investors, and so Gustavo, when you get to the level of the Silicon Valley Bank, theoretically these are supposed to be established, tech companies that now have board of directors, they have external auditors, and they're running their operation correctly. And it's like Facebook when they started, everybody when they did an IPO wanted to buy, and things were good. So run us through what a tech company has to do to get to the level of being, let's say, funded in terms of loans by Silicon Valley Bank.
Andrea and Orlando, thank you so much for the invitation. And thank you for taking the time to just give the audience a little bit of context. Yes, tech is different. That is a fact. Um, I come from a traditional business background for over a decade, and I've been able to identify the significant differences that exist from running a small business, a traditional small business from the ground up versus building a tech startup. So when we refer to tech startups, you do not go to a traditional bank and ask for money and present your business plan and get funded. That just is not the reality. The way you fund startups, you bring an idea, you establish the legal entity, and then from there you start working on raising capital. Some build product before what it's called a minimum viable product, and then from there the game is on to raise capital. And the reason, one of the reasons why these business models run and grow so fast is because of two items. Number one, the funding. So you pretty much go to what it's called friends and family or strategic angel investors who believe in two things. One, believe in the founders. Do I know who is behind this startup? Do I trust their expertise? And as Michael was saying earlier, do they have any industry expertise on what they're building today? Otherwise, as an investor, it increases the risk, and most likely I will not want to invest my money there. Then, once we have the founders feed, what it's called, then we move to product. Is this a product that I believe that hopefully the entire nation will buy? And we're talking about Uber, Lyft, Facebook, which is called Meta, Instagram, WhatsApp, and we can literally spend hours naming all of the unicorns, companies that have valuations over $1 billion that exist today. Once we have founders feed, and once we understand that there is a product that can rapidly be used by an audience at a market, then that's when you say, well, the risk in tech decreases. Therefore, this is a good opportunity for me to invest as an early stage investor. So that's one of the big items how this works. And then we need to be mindful that technology tremendously help us all to grow any idea and give it access to the entire, in this case, US market or to the entire world. So that on top of the non-traditional funding, which is 20,000, 100,000, 500,000 from different investors, then you have pretty much a startup with $2 million in the bank account, and that's how they grow super 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 fast. So it is part of the today, it is part of our world today. It's not going away. Now the question is, how can we leverage technology and grow these companies that add so much value to the American economy, to do it more responsibly?
It's really interesting, Gustavo, because I'm thinking to myself, the I suppose the race, if you will, la carrera in tech is to stay relevant. I can remember MySpace, for example. When it hit the scene, MySpace was great. Everybody was sharing music and videos, and then all of a sudden one day MySpace goes away. And we're seeing that there's a lot of pressure on Facebook. You can see now you've got Meta. They've been trying to acquire and buy other businesses to stay relevant. But then comes the Chinese on the scene with TikTok. And so there's a difference between tech and relevance. And let's say other industries like Shell, Exxon, BP, these companies are engaged in an activity that is pretty black and white. You drill a hole, You extract fossil fuels, you refine them, you sell them. There's always a market for it. Of course, the price of the refined product goes up and down, but it's a business model most people can wrap their arms around. In other words, I as a passive investor in the stock market, I buy Exxon. I know I'm going to get a dividend. I know I'm going to do better if the crude prices go up. But with tech, you know, look at the fiasco in Bitcoin. Look at the, MySpace. Look at all the tech companies that are here one day, gone the next. Is that a challenge for investors, and should they be
So,
aware?
and you bring a very, very valid point. Well, it is also relevant to mention that oil and gas companies today, and in fact, I hold a bachelor's degree from the University of Houston in petroleum engineering. And what that means is that I understand from an academic point of view how the business is, and I think it's a beautiful business. It is black and white. I agree with you. But then in addition, we don't call companies oil and gas companies anymore. We call them energy companies. There is a strong sentiment that there will be, and it's happening today, a more responsible way to extract natural resources and convert into or do an energy transition. And that's happening all over the world. It's something that I don't have control of. We don't have control over. It is happening. The reason also why today we're able to be more efficient at operating companies is because of technology. So before, let's say you're drilling down the hole and you needed to get data from what's happening in the field, well, you literally, it was taking more than a day, more than 2 days, weeks to be able to get that information. Today, because of technology, we have access to that information like this. That creates a more profitable enterprise. Therefore, yes, you're getting a bigger dividend distribution after buying stocks from Exxon. So it is, I think, more of a conversation of how do we do this more responsibly? How do we know that this is part of the stakeholders, a part of the ecosystem today, and how do we include them to be more responsible? And I pick back on what Michael was saying that yes, I mean, what do you mean there is a bank with no industry expertise? I don't imagine an oil and gas company with a board or with an executive team that does not have experience. And this happens actually today in countries that oil and gas companies are being managed and led by the government. So, not to go too far, there is a company today that the minister of oil and gas resources, it is someone that holds a bachelor's degree in philosophy. Well, we know exactly what's going to happen to a company like that. But bringing it back to tech, tech is everywhere. Every single today, this conversation that we're having is because of tech. And maybe this company like MySpace, it went viral. Yes, it is about keeping up the momentum. Yes, it is about keeping up the excitement. Yes, there is no profits. Yes, there is not going to be positive cash flow. But then it gets to a point that it could have been the case of MySpace, that an strategic acquisition happens. And you're like, but wait a second, what do you mean? They're not making money. There is no tangible assets. It's not a black and white business like we're used to. But then I was able to exit 3, 4, 500, $1.3 billion. We are building today at Trez $1 billion company. We got acquired by, or part of our company, 6% by JP Morgan via Techstars, which is one of the second or one of the largest accelerators in the world. There's Y Combinator and there is Techstars. So these companies grow very, very fast. Having and going back to Silicon Valley, it is the norm. If you are with the big guys, you must have your bank account with Silicon Valley. We actually, in fact, we were about to be banking with Silicon Valley, and I asked my founder, please, 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 let's do the transition. We need to move. The same thing with the law firm. There is law firms that you must use if you are building $1 billion company. No one knew. And I'm glad that we stayed with another institution. Therefore, our money is safe. And yes, in tech, It is very common because you have investors' money backing up your startup to have over $250,000 as your average balance in the bank account. I will be very interesting to see what the average balance is.
Gustavo, you say a couple of things very interesting. Well, definitely the world is being changing. We are being seeing more and more often business that are not black and white anymore. Tech is is now and the future. We cannot deny that, and we need to be more aware and responsible about that. So I want to ask the three of you guys, for the regular people, the community in general, what is going to be the consequence of something like that happened last week with the Silicon Valley Bank? And the consequence at all levels. And I want let's start with Professor, and then we're gonna start with Mike, and then Michael, and then Gustavo. And Gustavo talking about the meaning and the consequence on the tech companies and in your field. But with Professor at all levels, what is going to be the consequence at all levels, and the regional banks and the regular people, like the just the consumer in general?
Yeah, Andrea, to me, this is like the first crack that we saw in the economy. We've been talking about a recession for the last, 4 or 5 months, and it really hasn't materialized, right? The economy has been like just chugging along, and it's been going along very good. But to me, this is the first major crack that is an indicator of a recession. And there's other indicators now that are showing that, they're already like flashing red. For example, the price of oil is already, I think, around like $65 a barrel. The price of gold has actually shot up to above $2,000 an ounce. The Treasury bill has actually gone down to like roughly, I think it's like 3 point something percent, when it was already like above 4%, the 10-year bond. So there's like many different indicators, many different economic indicators that are actually like flashing red. And I think that's why the Federal Reserve and all these, economic authorities are kind of concerned about the economy. And as a matter of fact, right now we've been seeing like interest rate hikes, but the Federal Reserve is actually, well, not the Federal Reserve, but economists are actually predicting that we might actually see interest rate cuts by the end of this year. So right now we're like in interest rate hiking cycle, and we might see an interest rate hike tomorrow, but we might actually end up seeing interest rate cuts by the end of this year because we might see an economic slowdown or potentially a recession. So to me, this is like the very first crack of the economy, and we might end up seeing like other slowdowns in the economy, right? In the real estate sector, in the automobile industry, in different parts of the economy. I don't want to be pessimistic, but I think all these interest rate hikes that we had, where we went from virtually having an interest rate of basically
Negative
0%
rates.
to having
Negative rates.
basically negative rates, to having a federal funds rate of basically 5% has taken its toll on the economy. And this was the very first like major serious crack that the economy suffered. And the Federal Reserve, I think, knows this, and that's why they've acted so aggressively and so quickly on it.
Uh,
How is this going to affect the consumer? Well, it's going to affect the consumer in terms of jobs, right? I think
mhm.
what we're end up seeing is that the unemployment rate is going to end up at going up eventually over the next few months.
Michael, the FBI should get involved and investigate.
Definitely. I think there are, questionable practices that occurred here. Again, what you've got to look at is two things: the stock sales by the executive shortly before the bank failed, and then also potentially securities fraud by looking at the statements they made publicly about the health of the bank before its failure, and then also what they put in their annual report or their quarterly reports. What statements did they make about the health of the bank, and were those accurate? And I think on a practical side, also, this failure caused founders to kind of reassess their capital and risk management practices. You see venture capitalists reaching out to their companies, telling them to diversify their bank accounts, make sure that they're spread out, not kept in one bank specifically. And I think what I look at too is, for the Federal Reserve and the Treasury Department to guarantee all the deposits in this bank, does that send a message that it's okay to take risky practices? You know, because the government's going to guarantee all the investors. So I think potentially that sends a very dangerous message. But the opportunities for both criminal fraud as well as civil liability are ripe and high at this bank.
Well, from a public policy perspective, to me, it would be terrible. And this is what I say. It's going to be interesting to see what the Biden administration does if they're going to protect the investors. And you hit the nail on the head. I mean, disclosure is very important in all these documents. What did they disclose? Was there fraud? Beyond SEC violations and wire fraud and all that stuff. But
Gustavo, what did that means for tech companies like you or many of your colleagues that I know you know a lot of people in the Silicon Valley and you have a lot of friends and you're part of a big group that they have tech companies?
Oh yes, absolutely. I don't know if this was my reality a few years ago, but today I am fully immersed in technology, and so it was probably one of the most scariest 36 hours when the Silicon Valley Bank collapsed. I'm part of different groups, and in panic. I think Professor Perez was mentioning that panic and fear did not play well. And I entirely agree with him. There were a few CEOs, a handful of CEOs that knowing that they needed to keep the calm, they instead went and cashed out their money, which increased the panic, which increased the fear, and then we ended up having the situation. Not saying that this was the reason why, but definitely this accelerated the process. So it was very scary, and we did our best from our position to help our clients that were with Silicon Valley Bank to do a transition to banks like JP Morgan Chase and Bank of America and so on, just to make to take better measurements on situations. And all of us, absolutely, we need to learn from this point on how we need to behave with the positioning of our cash and how we are securing our cash. So it is a responsibility that all of us are holding today on how we propagate the message, right? If we propagate too much fear, if we propagate too much panic, then what's going to happen is that these will drive the economy or accelerate even more for what we've been now expecting, which is a recession. So I think in general, today, and I'm speaking of our organization, we hold a significant responsibility to our investors. We hold a significant responsibility to our employees, our clients, and we should be intentional and mindful about the message and the responsibility that we hold. Panic will hit our pockets. Fear will hit our pockets, will impact our pockets negatively. So now steering things more to a conversation of prosperity and understanding the strong values that the American economy holds beyond anything else is that we are resilient, is that this new wave of immigrants have the capacity to continue to lift up the country, and they are working more than anyone else to continue to lift the country and to lift the American economy, that we have key participants, that we have government, that we have large banks and financial institutions, and we have organizations that at the end of the day, or ideally, we all want the economy to prosper. And I will close with this: opportunities for tech companies, and the conversations are, yes, there are thousands of layoffs that are happening in the media. It's disclosing all this information, but then also new jobs are being added. Tech companies add significant job creation to the American economy just because of the nature of being backed by investors. So we don't have to wait 10 years to be able to have the money to hire professionals. And just to give you a perspective, a software engineer the starting salary it's somewhere around 110,000, 140,000. They do not have enough software engineers today to be hired in the market. So what that means is that we need to go back to the schools. We need to propagate the message and tell our kids, yes, the economy is strong. Yes, we might go through some roughness, but let's focus on what matters, which is waking up every single day, get to work because that's what we know best.
So the economy is, as you say. I know that people get excited about $200 billion bank, but the economy is a $1 trillion economy. It's huge, and the economy, the whole free market, is sort of like living on the Texas Gulf Coast. We get a thunderstorm when a cold front comes in. We can get a tropical depression. We can get a hurricane. Or in worst case scenarios, there are underground seismic shifts that are called earthquakes, but create tsunamis that we've seen. And then the worst, of course, is a meteor that hits the world from outside the atmosphere and basically abolishes humanity as we know it. So hopefully this is a thunderstorm, right? And that the regulators, the investigators, the FBI, the Securities and Exchange Commission will control this, but there are risks and you know Professor Liston was talking about this, that and talking about contagion and ripple effects. If there is a stronger recession, if unemployment ticks up, then we've had record mortgages written. Then people can't pay their mortgage. Then the banks begin to lose not only on the treasury notes that they're holding, but now their mortgages are in default. This creates a massive ripple effect, and so uh, no reason, I think, in my opinion, correct me if I'm wrong, guys, to panic right now, but it certainly merits some kind of, lifting the covers and looking to see what happens so it doesn't happen again.
And that's what my
Orlando, yeah,
that
I
we're
agree,
about
Orlando. I think
to finish
I,
the show, and that's gonna be the call to action. What is the message? Let's start with you,
I mean,
Professor.
yeah, I think Andrea, I mean, I think that there's risk ahead that wasn't there 2 weeks ago. That's the call to action. Like, just be mindful of the new risks that we're seeing in the economy, and take the appropriate measures. Whether you're a company or you're a person, just be mindful, be more careful with your investments, with your portfolios, stuff like that. That's pretty much it. Now, have we been through worse in the United States? Yes, we can. Yes, we have. We've been through the Great Depression. We've been through the Great Recession. We've seen stuff that has been way worse than what we've experienced in the last couple of weeks. So, I'm very confident in our, policymakers and our decision makers. We have the best of the best in this country, and they're going to navigate us through this, through this problem that we're experiencing right now. So, just be mindful of the risks that we're experiencing right now.
Michael, call to action. What is the message to our people?
I think the message is that the financial system, the banking system is sound. You should not be afraid to put your money into a bank. Now, you've got to be responsible. You need to make sure if you have a large amount of cash, you need to diversify that. Don't put all that into one bank. Spread your cash to minimize the risk.
That's fundamental.
Gustavo, call to action.
There will be tons of jobs in tech. So this could be a good moment also to train yourself and to prepare yourself to potentially do an industry transition. Tech is not going away. Yes, perception plays a significant role in driving the economy. Consumers and business confidence are shaped by perception. So in general, perception can impact the economic behavior of our economy. So let's make sure that we continue to work every day, that we keep the calm, and that we keep our jobs as entrepreneurs, as part of large enterprises. We need to make sure that we make responsible decisions. We need audits. We need to be reviewed by external participants to ensure that we are doing the right thing so these jobs can continue to exist.
I'm always fascinated that, at least when I was at the University of Houston, the Department of Political Science and Economy were considered social sciences, where they study human behavior, sociology, economy, and political science. So, yes, economists have always been trying to figure out the human psyche and how that determines financial activities, as opposed to business schools where you actually study finance, which is, the spreadsheets and how you're going to report and formulas that, this and then you get that. But the economy and economists still, it's about human nature and human psychology. And that's what we can't put our fingers on, how people will react. So I'm
And
glad
now
that
we have artificial intelligence on top of that.
so I'm glad that everybody is like, talking about staying calm, that the economy is a lot bigger than one bank. But I think we're all in agreement that we should look into this, investigate it, analyze it, and make sure it doesn't happen again.
Dr. Daniel Perez Liston from University of Houston, Michael Anderson, retired FBI and longtime friend, and Gustavo Suarez, founder of Trez Tech Company. Thank you so much, the
Thank
three
you,
of you,
gentlemen.
for put us in context what is going on and send a message to our public. Thank you so much.
Thank you.
Bye-bye. All right, Andrea, let's remind everybody, April 5th in Dallas, Texas, we're doing our annual Tough Tejano Award, where we're honoring our former Supreme Court Justice Eva Guzman and former Congresswoman Mayra Flores, among others. It'll be at a luncheon at 11:30 at Gilley's, just outside of downtown Dallas. If you want to attend, please go to toughtejano.com. It's real easy. TOUGH, Tejano, TEJANO, toughtejano.com.
Or visit us as Texas Latino Conservative.
Yeah, or just go to our website and sign up. If you're in the Metroplex, we've done these in Houston. We've done it in San Antonio last year. We've sold them out. And hopefully Dallas folks will attend. So April 5th, Tough Tejano Awards in Dallas, Texas, Gilley's at 11:30. It's a luncheon. Please join us. Go to our website, toughtejano.com.
Or you can find everything, all the information about all our events and how to become a member in TexasLatinoConservatives.com, TexasLatinoConservatives.com. Thank you so much. Muchísimas gracias por habernos acompañado y nos vemos el próximo miércoles. Chao,
Hasta
chao.
luego.